How to tell if a trend is reversing or continuing. Traders will examine the details in price candlesticks, single candlesticks and groups of candlesticks. They'll look for formations in line charts and groups of candlesticks that indicate greater supply or demand or switching momentum. Traders may also read order flow, which is also called level 2 analysis. When is a trend likely to end? Well, it may seem obvious, but uptrends end when prices stop going up. Downtrends end when prices stop going down. Traders watch the ebb and flow. Is the market ebbing upwards or is it ebbing downwards? There are rarely straight line vertical moves in trading. A market goes down and then it pulls back slightly. It reaches a consensus level of value and then it starts moving down again. Does it make a lower low? If not, then the trend may be ending or reversing. Levels of value may be horizontal or they may be dynamic and sloping. They may be extreme levels or they may be average levels. Orders in both directions are likely to increase around value levels, and this is where traders set their buy and their sell orders. Trends end and reverse at extreme levels of value. Trend continuation and reversal confirmation tends to take place at average value levels and within pullbacks. Trends consist of breakouts and pullbacks. Breakouts make new price extremes. Pullbacks bring price back to averages and value. It's important to notice what happens before a pullback in order to determine whether the pullback may result in trend continuation or reversal. And it's equally important to notice what happens at value to determine whether the pullback will turn into trend reversal or trend continuation and a further breakout. Sometimes a single price period represented by a candlestick provides sufficient information for a trader to make a judgment. Certain candlestick formations are statistically more likely to result in some form of reversal. Identifying market turning points as close as possible to the apex of the turn is a core skill for traders. It allows them to manage their risk and maximise their profits. Their risk on a trade is determined by the difference between their entry point and where they'll get out of a trade with a loss if they're wrong. This can be and should be identified before a trader takes any trade. Traders set their exit or protective stop for a trade on the other side of a turning point. The closer the entry price is to the other side of the turning point, the lower the risk. This is an intricate skill and a chicken and egg situation for a trader because the trader needs sufficient evidence in order to make their decision, and the more evidence, then the greater the level of risk. The lesser the evidence and the lower the probability of making an accurate judgment. It's a balancing act. Perceived value extremes and numerical averages provide popular context for turning points, and they are therefore scrutinised and used by many traders. Traders can never eliminate risk, but they can manage risk, and this is what successful traders do better than the rest.